It's preparing to live stream the webinar.
Okay.
Done.
Yes, it's showing webinar is now streaming live.
Okay. All right.
So
I
how
think
do
from
I leave?
so I think you can now make Gilbert as the host, and then he will broadcast. Yeah.
Yes. All right, so I think we are ready.
Okay, bye.
All right,
thank you so much.
You're welcome.
Okay, so we're ready. Let's start. Good afternoon, everyone. I hope that you're doing well this Friday afternoon. My name is Gilbert from Forex STL, and in conjunction with Scope Markets, we're here today to give you a webinar entitled Contrarian Trading. Let me share my screen so that you can see it. There we are. So this webinar for today is to do with contrarian trading. There's a webinar that I did about a month back where we were talking about leading versus lagging indicators. So there was one that we talked about leading versus lagging indicators, and I might reference a few things from that webinar. So in case you missed that, my colleague Sylvia, who is here with me, she'll be moderating the Q&A. So I think, Sylvia, you can share links to our YouTube channel so that those of you who missed last month's webinar, you can be able to access it from our YouTube channel. All right, so contrarian trading, using hard mentality to make trade decisions. So if you look at this photo here, you can see these cows just following each other as they jump off a cliff, saying it's a hard thing. So what is this contrarian trading all about? Now, before we begin contrarian trading, let's just briefly look at market psychology. Now, market psychology is the behavior of the market. Why people behave the way they do, or why the market behaves the way it does. So in market psychology, trading involves anticipating what the majority will do at a certain point in time and then making the move in advance. So if you're new to trading, we usually do a couple of webinars every week. That's under Scope Markets with our very good trainer, Rufus. Usually covers a few topics here and there every week. That's Monday to Thursday. And then on Fridays, we do either guest webinars or we do webinars such as this where we're tackling specific topics. So in trading, what you're trying to do is you're trying to predict the future. And the best way of predicting the future is to predict what the participants in the market are likely to do. So if you know what they're likely to do in advance, then you can be able to make that move before the rest do it, such that when the rest of the wave comes in, then it can push you into profit. Humans are extremely social creatures with an ingrained instinct to follow the crowd. Now, this is quite true. We tend to do things based off of what other people are doing. So if you hear people are buying a certain asset, then everyone will want to buy that asset. If you hear people have moved, maybe your colleagues have moved to a certain area, be it Kilimani, Kileleshwa, you know, the uptown areas, then you too would also want to do that so that you can fit into that group. And this kind of human behavior also translates in the market in how we think. We tend to think the same way even when we are trading. Safety in numbers gives confidence to our beliefs and in turn, our behavior. We feel more safe when we are doing things that we know other people are also doing. I don't know if you've ever come across people who invest in pyramid schemes. you'll always hear them say, but so-and-so invested in it, nakapata pesa. So-and-so invested in it and made some money. So-and-so invested in it and made some money. So because there are people that you know who are doing something, then that gives you confidence in doing it, even if it is the wrong thing. The fear of getting left out of an opportunity greatly influences traders to jump in the market when the trend has been well established, often quite late in the game when the trend is cooling off. That is coming in too late. And there is a diagram that we'll be looking at which explains this this cycle of how we make decisions. You know, when we're very skeptical, it begins with skepticism. Then as we start to see, oh, wait, people are making money, then eventually we get to that level where we are now completely convinced that, you know, we should jump in. And because you're late, you end up jumping in heavy. And unfortunately, you come in towards the end of the opportunity. A very good example of this was earlier on in 2017 during the Bitcoin rally, when Bitcoins had been rallying since 2012 up and until the first peak that they reached in 2017. And a lot of people, especially here in Kenya, we saw so many companies come up that were promoting Bitcoin mining and the like. That was in 2017. Everyone was asking about Bitcoin. Even when you went to upcountry, personally in my upcountry, I had one of the villagers there asking me about Bitcoin, how they could get into Bitcoin. And that's the time I knew that, you know, the prices were now likely to start falling. So it's no surprise that a large number of retail traders lose money in the long run when you consider that a lot of traders are taught to think and act the same way. So if your trading methodology causes you to lose more than you gain, so here's a question: would inverting it change the outcome? So that lays the foundation for contrarian trading. If you've been trading a certain way, maybe you've been trading for some time. I know in the audience there are either new traders or also seasoned traders. Have you ever gotten to a point where you just seem to consistently be losing? You may make a few gains, but then at the end of the month or at the end of the quarter, you're still at a loss. And maybe this loss is building up, so your capital is depreciating. So would understanding what you're doing and then inverting it, would it lead to a different outcome? So this lays the foundation for contrarian trading. So what is the contrarian theory of trading? So the contrarian theory of trading is a theory that recommends making investments contrary to the apparent direction of the market or of commonly held wisdom. So this is looking at the market, looking at the psychology in the market, seeing what people are expecting from the market, and then taking an opposite opinion or taking an opposite position of what the general market thinks. The theory holds that if everyone is certain something is going to happen, then it will not. There are those people who say majority wins. There are those ones who say majority are wrong. So if you're on the camp of majority are wrong, then that means that you're looking at the contrarian way of trading. So identify what the majority of market players are doing and then do the opposite. For example, if everyone is buying an asset, the contrarian is selling and vice versa. Now, this type of trading is usually applied in situations characterized by very one-sided or crowded market psychology. This is when the market has reached a level of saturation, either on the upside or on the downside. So this kind of contrarian thinking usually applies when the markets are very irrational. That means everybody assumes that this investment can never fail. You know, everyone believes prior to 2007, 2008, the housing mortgage crisis of the US, that housing prices can never go down. You know, the housing market has never gone down, so it will never go down. And at that time, people were taking on mortgage debt to levels that had not previously been seen. You could have one person who's servicing about 7 different mortgages. Why is that? Because real estate, playing in the real estate game tends to be the one that creates the most millionaires. And we've also seen the same thing here in Kenya, where people who got into real estate early have been able to make quite a lot of money. But then when everyone is in the business, when everyone decides that that is the one thing that is going to make them the money and they all get in, this is where irrational behavior comes in, irrational thinking. And when the markets are irrational, that is the best time to take a contrarian approach, because you know that either there is a bubble in that case, or if it's on the downside, people are so fearful of something, they're running away saying that, you know, the sky is falling, this is the end of days, everyone is selling. That is the time for you to also take a contrarian approach. So you're looking to do the opposite once the market is deemed to be behaving in a very rational way. All right, so that's the contrarian theory. Now, there are different ways of approaching contrarian trading. So there are different techniques to contrarian trading. We're going to look at three. So the first one is the technical approach. The second one is the fundamental approach. Fundamental approach tends to be the one that is used the most, especially in stocks. So for those guys who are trading stocks, even on the stock markets platform, or if you trade stocks via the exchange, for example, here in Kenya, the NSC, or if you have connections to international exchanges such as NASDAQ or those other American exchanges, and you're trading shares, then you'll realize that a lot of the traders in the stock market tend to use a fundamental approach. And then there'll be the third approach, which is the market sentiment approach. All right, so let's look at the first one, the technical approach. So how can we do contrarian trading, or how can we make contrarian plays using technical analysis? So in this approach, we are going to be using technical analysis to predetermine market swings. So what we do is you look for support, strong support and resistance levels in the market where there is hidden supply and demand zones. And there are different ways of identifying support and resistance levels that are not clearly visible on the chart. So you can either use the ones that are clearly visible on the chart, or you can use hidden supply and demand zones, or you can use tools that can help you gauge or identify hidden supply and demand zones. And one of those tools is what we call the market profile. And market profile works best if you have a connection to the futures exchanges, but you can still be able to use the kind of volumes that you have on the MetaTrader, which are called tick volumes. So you can get this even on the market. If you go to the MQL5 website, you can be able to find some people who've offered this indicator for free. It's called market profile or volume profile. And what it does is that it shows or it displays support and resistance levels, or it gives you an idea about the support and resistance levels based off of how many times the market, or how many times the market moved within a certain point. That means that there was a consolidation of orders that was taking place at a particular price or a particular prices. And that can give you an idea that, you know, within that price range, there was a lot of trading activity that was taking place. We might not have seen it on the chart in terms of our typical price action chart. However, behind the scenes, because of volume, there was a lot of activity that was happening at a certain price. So that means if we approach that price sometime in future, we might see a reaction. You can also identify extreme highs and lows using indicators, these leading indicators that show you overbought and oversold conditions in the market. So that's another way of using contrarian trading, using the oscillators or some of these leading indicators. For example, RSI, stochastics, you have the CCI, some of the indicators that we talked about in the previous webinar. Another way of using the technical approach is divergence trading. So where you're looking for a divergence between market prices and technical indicators. It could be a divergence between market prices and volume, or it could be a divergence between market prices and, say, the velocity or the momentum that the market was moving in previously. So if the velocity has reduced, yet the prices are still rallying, then it means that there's a bit of a divergence. So this type of trading, divergence trading, also there's another type of trading called mean reversion trading. And in mean reversion trading, what you're doing is it's based off of the assumption that market prices revert back to their mean. So if you have something like a moving average and the prices have skyrocketed above that average, at some point in time, they will revert back to the average price. Same thing if it goes down. So if the market prices fall way below the average, at some point they will revert back to the mean price or the average price. So here's an example of mean reversion, how mean reversion trading works. So here you have some kind of a moving average indicator, as you can see there. There seem to be two moving averages, a fast and a slower moving average. And that shaded area represents the difference between the faster moving average and the slower moving average. Now, by fast and slow, it's just to do with the calculation. We could be having one average that is calculating a smaller period of, it's calculating an average of fewer candlesticks, and then the slower is calculating a larger average of candlesticks. So it could be maybe like a 20 period exponential moving average, and let's say a 50 period simple moving average. So one is calculating an average of the last 20 bars, the other one is calculating an average of the last 50 bars. So in that case, if the prices rally above, a distance above the average, so this line is the mean price. Already they can, yes, I think you can be able to see it. So this average here is the mean price. And when the prices rally above that average, at some point they're going to revert back to the mean price. So you can see by these icons here, or this illustration, there is an overextension in the market. So at some point, the market prices will have to go back to the mean. So you could see those two overextensions. And even when we were moving on the downside, so when we were on a downward trend, you could see some overextensions to the lower side, and the prices would revert back to the mean. All right, so someone could also refer to this as counter trend trading. So it could also be counter trend trading, but there are times where you could be trading back into the trend. So if you look at this, in this illustration, I don't think there's a section where we could say that we'll be going back into the trend, but maybe in the next slide, I'll give an example of how you could, it's not really counter trend trading, but you could be trading to get back to the prevailing trend. So this is an example of mean reversion trading. I would also want to give you an example of using the oscillator. So when you're looking for overbought and oversold conditions in the market, this is RSI, Relative Strength Index. It's an indicator that is used to identify overbought and oversold conditions in the market. It's a velocity-based indicator. So as you can see down here, when RSI has a range of between 0 to 100, 100 being extreme upside velocity, and then on the lower side, that is towards 0, that is extreme downside velocity. So when we approach 30, so when we are at 30 and lower, so 30 and below, that is considered oversold. And when we are above 70, so between 70 and 100, that is considered overbought. So in this oversold zone here, what RSI was telling us is that the prices have moved down too quickly. So what we're likely to see is a cooling off. Now, someone who doesn't have RSI could still assume that the trend would continue going down. They could have even looked at some candlestick patterns here and decided to short sell to carry on with the downward trend. However, someone who's a contrarian trader would be looking at RSI and say, no, the market is likely to cool off. So instead of us selling, we're actually going to be buying. We'll be looking for buying opportunities. And as you can see, the prices eventually went up. Then when they got to the overbought area, someone could be saying, all right, maybe this is a good upward trend. Let us jump in on this upward trend. They can look at maybe some price action there. It could have been a resistance that the market has broken that resistance, and they're like, let's carry on with the trend. However, as a contrarian trader, you'd be looking at RSI and saying, this is in an overbought zone. So ideally, the markets should revert back. They should turn back because the velocity has increase too quickly. So we should see a cooling off in the market. So they'll be looking to do the exact opposite of what maybe others are planning to do. So that's an example of the technical approach using, I wish I had more slides here, maybe to look at divergence. But if we have time at the end of the presentation, we can go to the charts and we can look for a live example of maybe divergence that is taking place in the market. All right, so that is the technical approach. If you have any questions, kindly put them in the Q&A section and then I'll address them at the end of the presentation. So I want us to look at the second approach, which is the fundamental approach. Now, the fundamental approach is the one that is quite weighty because most of the contrarian-based trading that is done on a large scale uses the fundamental approach. This is the one that has case studies where there is enough data to show that contrarian trading does actually work when you're using the fundamental approach. So what is the fundamental approach all about? It involves evaluating the fundamental value of an asset, for example, shares of a company. And it is known also as value investing. So if you've heard of this terminology, I know Rufus in one of his webinars has talked about value investing as one of the forms of trading. So value investing just basically means you're looking at the business performance. You're not looking at the share price per se. You're looking at, how the business is performing as a way of understanding or as a way of being able to derive a decision as to whether or not you want to buy it at the current market price. So whereas technical analysis, you're looking at chart patterns, you're looking at technical patterns, or you're looking at a technical view of things in terms of price movement, either price and volume. In the fundamental approach, you're looking at, how the business is performing. That is, if you're looking at stocks. If you're looking at forex trading, then you're looking at the health of the economy. How is this economy doing? So if we were to say, all right, let us do an analysis of the Kenya shilling to find out whether or not it's likely to increase in value against the dollar or whether it's likely to decrease in value, then there are those economic factors we'll be looking at. And we would use our analysis of those economic and geopolitical factors to determine whether or not the Kenya shilling was likely to increase in value or it was likely to decrease in value. So in value investing, in this case, I'll use the stock market approach or the stock market examples. In value investing, a trader would be looking to buy an undervalued stock in the market. And this is because in value investing, you're not really looking to short sell. You're looking to invest in the company, not looking to speculate. So in that case, you'd be looking for undervalued stocks and then making a trade and then waiting long enough for the market to realize that these stocks have value such that they can jump in and then push the prices up. So traders who are doing this value investing, they'll be looking for companies with a few of these ratios: a low price to earnings ratio, also known as the PE ratio. Another ratio they'll also look at is the price to book ratio. Two others or three others that they'll be looking at is price to sales ratio, debt to equity ratio, or even return on assets. So let me describe a little bit about this ratio. So the price to earnings ratio is the ratio between the market price of the share and the earnings that the company has made. So how much dividends you're getting, right? How much return have you made in your investment in terms of the price at which you, not really the price at which you bought the share, but in terms of the dividends, what yield you're getting from that investment. Then we also have the price to book ratio. Maybe if I can give an example of a company with a low price to earnings ratio. It could be a company who, if you look at the share price, it's trading relatively low, such that if you were to invest in it, let's say the share price is currently at 20 shillings, and they pay a dividend of, let's say, 2 shillings. let's say they pay a dividend of about 2 shillings per share, yet it's currently trading at 20 shillings. That in itself could be a low PE ratio, could give you a low PE ratio, because it means it'll take you at that rate, it might take you about 10 years for you to recover your investment, right? So there's that return on investment. So that would be about 10 years. What if maybe the share price is trading at 10 shillings, but then they're giving a dividend, they've been giving a dividend of about 2 shillings per share. So that means, right, what you're getting as a return on your investment is about 20%. So every year you're looking to get a 20% return off of your investment. And that is if that trajectory continues, that they continue giving that 2 shillings dividend, or even the possibility for it to increase to 3 shillings or even 4 shillings, yet you bought it at 10 shillings. Then there is the price to book ratio. Price to book ratio is the ratio between the market valuation of the company versus the book value, right? So there are always those two things to look at. There is what people are willing to pay and what the company is really worth, right? So there's usually that discrepancy. Just the same way people would be willing to buy something. I think the best example of this, maybe if you're into fashion, there's something that usually happens with particular brands. For example, these shoes called by Nike, these Air Jordans. What happens is that they release a very small number of these shoes, of these pairs. It could be a certain design that they're releasing, and they'll release it in small amounts to create a lot of demand for it. So people would be willing to pay a lot for it because it is scarce, it has been made scarce. It's not really that shoe is better than every other shoe, right? You could even get a better priced shoe that does the same thing or is even better, but it's going to be priced much lower. So there are always those two things, what people are willing to pay for an asset and what it's really worth. So as a value investor, you're looking for the true worth of that asset, not the price people are willing to pay for it. So that's PE ratio and price to book ratios. And these two tend to be used a lot when it comes to value investing. But PE ratios can be manipulated. A good example here in Kenya, there's this company called Scan Group. It's Canada or Scan Group. And its share price has been falling ever since its initial price offering. It's been falling over the years. And about a year or two ago, their PE ratio was quite low. Share price had dropped below 10 shillings, and they were giving a dividend, I think, of about 3 shillings per share. So if you look at that, your return on investment, you bought the stock at about 10 shillings, and that year you got a dividend of 3 shillings. That meant a 30% return on your investment. So that was a very good PE ratio. It was quite low. So that would have tricked an investor into thinking that this is a good trade. Why don't I just jump in? As much as the trend is down, if you look at the price trend, the prices are falling. But then there is a really good PE ratio. So that means that would be a good buy. However, those PE ratios could be manipulated too by the board members of the company or whoever is really running the show there as a way of trying to curtail that fall in price. So you also need to look at other things like the price to sales ratio. You're looking at the sales that the company is making. And if you look at that company, Scan Group, their sales have been going down by 20% every year. So even if it has a good PE ratio, you also need to look at sales. What are the revenues for the company? What are the profits that the company is making? Are the sales rising or are the sales going down? Because so long as sales are rising and they're being able to make business, even if they're not turning a profit the way they would want to turn a profit, but the fact that they're increasing their revenues means that all they need to do is just, they just need a better way to ensure that they turn a profit. But so long as the product that they're selling has demand, that means they can continue to improve on the revenues, then being able to turn a profit at some point, they work it out. So that's for value investing. Now, value investing is all about getting the best deal. And it is similar to getting a great discount on a designer brand. So just like I was saying, there are those designer brands, or there are those designer brands that are quite overpriced. You know, they create a shortage. They manipulate the market into paying extra for it. But then there are those particular brands that you find that they're underpriced, right? It could be anything. It could be, you know, from fashion industry. It could be even from manufacturing. It could be like even some of the phones that we see. They have very good features, but because they're not popular, people are not buying them. So they tend to be priced lower. So you could be getting a good deal for value. So here's a quote from Warren Buffett. I will tell you how to become rich. Close the doors. Be fearful when others are greedy, and be greedy when others are fearful. So here's an example from one of the best, or one of the greatest investors of our time, Warren Buffett. He's also a contrarian trader. And one of his most recent famous trades was during the housing market crash of 2007, 2008, because the housing market crash spiraled into a financial crisis, a global financial crisis. So we usually refer to 2008 as the Great Financial Crisis. And during that time, when asset prices were falling, Warren Buffett was advising people to go buy these assets right now because they are that cheap. You're getting them for cents on a dollar. So that is the time for you to go in. When everyone is running away, screaming that the sky is falling, that's the time you get in. Why? Because you'll be able to get something good at a bargain. And of course, at that time, it's very difficult for you to do that. Why? Because the market sentiment, the psychology in the market is one of run away. You know, sell off everything, run away, and hide. So as a contrarian trader, you're supposed to be looking at what the heart is doing. Everyone is running away. No, I'm not going to run away. Let me really analyze what's going on so that I can find whether there's any value for you, whether there's any value that you can be able to take advantage of. So that's Warren Buffett. So in one of those, I remember him. This I remember because at that time I was new to trading. And I remember in 2009, he said that he's betting on the US dollar. That was the year when the US dollar was just plummeting against the euro, against the pound. The US dollar was really losing value. However, Warren Buffett came in, I think it was mid 2009, and he said that, oh, he's really betting on the dollar. So he's made investments in the USD as a currency trade. He's made investments in the USD. And I thought to myself, this guy is really crazy. Why would he be buying the dollar when it is being sold off so aggressively? Turns out he was correct. And a few years later, the dollar started to rally. Once this financial crisis spread over to Europe and the European markets were falling, people jumped back to the US because the US had started to recover. They had acted quickly with the quantitative easing and other economic policies that were introduced by the Federal Reserve. And what they did is that they were able to stimulate the economy, and the US economy recovered faster. So this is a guy who made these trades about 2 to 3 years earlier, before the market actually caught up. So that's a contrarian trade. At times you have to be very patient, but you have to really know what you're doing. So it cannot be guesswork. With contrarian trading, you cannot just be guessing. You have to back up your trade. You have to back up your analysis, and you have to build a story around it. You have to have a reason as to why you're doing what you're doing, or a reason as to why you're going against the rest of the market. All right, we'll talk about, if we have some time, we'll talk about other trades, more recent trades. Maybe I can just mention, because that was also a fundamental trade, when we're still on this section for the fundamental approach. I don't know, have any of you heard about this company called GameStop? There's something that was happening this year with its stock. Its stock price just shot off the roof, and it was on a downward trajectory over the past 3 to 4 years. The share price had just been falling, and a lot of hedge funds were short selling that stock. because they had done the analysis and they were like, there's no value in this company. First of all, even if they've added a new CEO, that new CEO, they don't really have any confidence in him. Again, the market for selling video games, physical video games in the form of those discs, the Blu-ray discs, so like that business is going down. It's moved online where people are purchasing the games online and downloading them to their gaming consoles. So they have created a whole narrative as to why this whole business of the game stores, where you'd go to a store to buy video games, it's going to die. Just the same way the business of video, remember what they used to be called? Not video bureaus, where you'd go and rent a video to watch. You go and rent either a cassette, a VCT or VCR back in the day, for those of you who are quite old, or for DVDs, where you'd go and rent out a DVD. So maybe you'd go pay 30 shillings, get the DVD, you have it for the whole week, and then you have to bring it back. That business died off, right? Everybody buys these movies online and you can download them. So that was the reasoning behind what the hedge fund traders were doing. They were like, this whole video game business is over and done with. However, there were those traders who looked at what was happening, especially last year. They saw that the video game makers, especially the guys who created the consoles, the video consoles, that is PlayStation, Xbox, Nintendo, what they did is that they were still releasing versions that had a place to put in a Blu-ray disc. So they had not removed the place for putting in a disc. And that meant that they were still looking at, or there was still a demand for people who want to buy the physical disc. Because something that happens in these video games is that if you buy the online version, there are restrictions. You can't share it with someone. You can't also resell it. So people still want to have that control over what they purchase. So if you purchase the physical one, you can always lease it out to someone else, or you can even sell it off. And there's a huge resale market for used video games. So there are some traders, most notably was the one who called the one who was quite famous. In fact, a movie was made about him called The Big Short, and he was able to predict the mortgage crisis of the US back in 2005, 2006. He made about $1.3 billion by betting against the housing market. It's called Michael Burry. So guys like Michael Burry had a different opinion of GameStop, the GameStop stock, and they bought it, I think, when it was approaching around $10 a share. I think it was under $10 a share. That dropped down to almost $2 a share. And he was of a different opinion, and he started buying. So he was going counter to what the industry players were doing. These were hedge funds, and these are people who have a lot of money. And other traders caught on to what Michael Burry was doing, especially in these Reddit groups like Wall Street Bets, and they also started buying the stock aggressively. And before you know it, within a month or two, a stock that was worth about $2. I don't know, keep on going back to shilling. A stock that was worth $2 rallied, and it was even priced within just about a month or two. It had even gone to as high as $340 something per share. So that is more than 10,000% return. Someone who bought it at $200 and at $2, and cashed it out at $200, that is a person who would have made a return of 10,000%. So that's a very big return. You'd have walked out with 100 times what you initially invested. So that's also a good example of a contrarian trade that was using the fundamental approach. All right. So with fundamental approach, you really have to do your research. You cannot just jump into the market like that. All right. So let's look at the third approach. The third approach is the market sentiment approach. And in this approach, what we're looking at is the general feeling or attitude that traders have towards the direction of prices. So that is what market sentiment is. Just the general feeling and attitude that traders have towards the market. It isn't always synonymous with fundamental value. So it is mostly to do with feelings and emotions. So market sentiment, when you're gauging market sentiment, you're not trying to see the fundamental value as to why people are doing what they're doing. You're trying to see what is driving the emotions. Why are people overly buying a certain asset? Why are people overly selling a certain asset? Market sentiment can be gauged as either bullish or bearish, and it can also be deemed to be mixed if there is no clear consensus as to which way the market should go. Most strategies are built on the premise that investors are rational. However, most investors are irrational, and their behavioral biases tend to lead to the market, and their behavioral bias tend to lead to market overreactions in either direction. So there is this notion that we're going to be rational in what we're going to do, and you may start out that way. You have a plan, you have a strategy, you know exactly what you're supposed to do, when you're supposed to do it. So we build rational models. We test them in the past to see that they work. And so we are planning on implementing them the same way in the future. And ideally, they should also work in the future. However, what happens? What happens? As the market starts behaving a certain way, you may, or especially in terms of losses, start making a few losses. You start changing. It impacts your psychology. Start thinking, oh, I'm going to lose my money. Look at how much money I've lost so far. Oh, I'm going to lose my money. You start to change your behavior. You start to change the things and the rules that you had laid down. And this happens even to the best of us. It happens to the best of us. So the moment you get to a period where your market performance or your performance in your account is not consistent with how it has been performing, the first thing that someone does is they start thinking the strategy has failed. They start trying to micromanage the situation, and that leads to more mistakes, and those mistakes leads to more losses. Contrarian traders look for periods of excessive optimism and pessimism. So this is the cycle. This is a diagrammatic representation of that a trader's decision-making process. So it may start out here with optimism, enthusiasm, exhilaration. As the trend is going in your favor, everything is going according to plan. It seems as though it's easy money. Each time you buy, you're always closing it at a profit at the end of the day or at the end of the week. Everything seems so nice and easy. You even get to a point where there's a lot of euphoria. So what happens? You start to increase your risk. Maybe you are doing mini lots, the lot volume 0.1, 0.1, 0.1. So from a trade, you are doing $20, $30, $20, $30. Then because you've been so consistent and this trend just seems very obvious, you decide to start increasing your risk. Maybe you move to 5 mini lots, that is lot volume 0.5. So instead of now doing $20, you're doing $100, $100, $150. Then eventually the market starts to change, it starts to turn. So you become a bit uneasy, because things are not going the way you had projected. You start making bigger losses. You reach a point where you're in denial. No, there's no way this market is going to turn. We've been on an uptrend. We're going to recover these trades. Then it goes into pessimism. Now you're very pessimistic. You're not sure what's going on. You believe that you're going to lose your money. You move on into a panic. Then it eventually turns into despair. So when you get into despair, that's the time you're thinking, okay, let us exit from this trade and start closing out your trades. After you close the trades, the market starts to move again. Same direction that you were in originally, start getting a little bit of hope. Hey, wait a minute. Maybe the market might start to move again in the direction. Turns to relief, especially if you hadn't closed out all your trades. You're not break even. There's a bit of relief. You're like, that's a good thing. It's a good thing I didn't close out all the trades. It moves again into optimism, and then the cycle repeats itself. I don't know if you've ever had a situation whereby you close a trade, a very big loss. Things were not going well for you. You held on to it, turned into a big loss, and then you close it. The moment you've closed it, the market just seems to turn back and go in the same direction you had projected. And it keeps going in that direction relentlessly. Almost feels as though there's someone who's playing mind tricks. That is the sentiment. It's not only happening to you, it's happening to very many people. We tend to make decisions the same way. Even if we are miles apart, we tend to reason and make decisions the same way. All right, so there is a sentiment index that we can use to give us an idea of this extreme optimism and pessimism in the market. And there are two of them. We have the retail trader sentiment index and the institutional trader sentiment index. And what these indices do is that they measure the positioning of retail traders and also institutional traders in a given market. And the kind of information that it gives us, or what they use to tabulate the information, is either by the asset. So it could be, this is how they group the data in the index. They group it by the asset. So it could be a stock, it could be a particular currency pair. Then it shows you the long and short, the total long positions that are on that pair, total short positions that have been taken on that pair. It also shows you the average price transacted for both going long and going short. So the guys who are going short, what was the average price that they were going short at? The guys who are going long, what was the average price that they were going long at? And then it can also show you the total trade volumes on each side. So how many lots for going long and how many lots for going short. So this is what, this is the information that we'll be able to get from the retail, mostly from the retail. The retail sentiment index can give you quite a lot, but also the institutional trader sentiment index can give you most of these metrics. Let's start with the institutional sentiment index. This shows the positioning of large investors such as hedge funds and also investment banks in the futures and options market. So this index, we get it from the futures and options market, and that is because most of the big traders may not be that active in the spot market. And the reason for this might be due to broker risks. So if they're moving huge amounts of money and maybe their broker is a market maker and they end up being correct about the market, you know, the broker might become insolvent. They might not be able to honor their end of the deal. And that's the reason why the large traders would rather go to an exchange, because at an exchange, everyone who's taking, regardless of whether you're on the buy side or on the sell side, everyone must meet the obligation. And there are rules of being able to trade in the exchange. So it shows the positioning of these large investors' position. Well, it shows the positioning of their trades in the futures and options markets. And due to the nature of these markets, the sentiment is used for medium to long-term trading. And this is because for the big players, they may be building a position that is medium to long-term. So when using the institutional sentiment index, you may find that it's going to take you quite some time before you can get a contrarian trade or an opportunity that you can be able to make a contrarian trade. The data is updated either daily or weekly, depending on the reporting procedure. And the most common type of sentiment index in this institutional space is the COT report. For some of you, I know you've heard about this COT report. It's been mentioned a few times in the guest webinars that we've been conducting on Fridays. And it's called the Commitment of Traders Report, and it shows the positioning of these large traders, actually quite a group of traders. You have the hedge funds, those are the large speculators, hedge funds and investment banks. You have the commercial traders. These are companies that are not involved in the financial markets, but they are affected by these prices. So they're in some kind of a large-scale business where they need to hedge. They need to hedge the exposure in the market. And then you also have small speculators. Then from there are also called the segregated reports, which also show other types of traders. Could be having money managers, could be having market makers. So it's a very wide report. You can use a very specific part of it, or you can be able to use all that information from all the participants. However, in this index, the two players that we look at, so this is an example of that index. This is on a share. So this is a share price. This is the chart right there. It's a bar chart. And then down there, you have the COT report. And it's being represented graphically. So the report you can either go to the CFTC website and read the report, the numbers, or you can input an indicator. There are some of these indicators that are available. For MT4, it's a bit tricky. MetaTrader 4, MetaTrader 5 is a little bit tricky, but there are some traders who've been able to create a plugin for that can be able to pull this data from the CFTC or from other websites, and then it's able to tabulate it for you on your charts, on your MetaTrader 5. I think I saw one on the MQL5 website. So if you go to the MQL5 website, I believe there is one that has been created for MetaTrader 5. My apologies, I didn't bookmark it, but I know it's there on the MQL5 website. So if you go to mql5.com and you search for the court report indicator, I'm sure you'll come across it there. So in this indicator, what we are looking at is the difference between these two players. This is the commercials, the ones represented in red, and the large traders, these are the large speculators we are talking about, the hedge funds and the like, represented in green, and then the blue is the small speculators. However, for this index, we normally look at the commercial traders. And the reason for this is because the commercial traders are not speculators. What they're doing is trying to lock in a good price for their trades. And they will actually take delivery of whatever asset it is that they have booked to buy, and they will also sell physically whatever asset they have booked to sell. So what happens is that when the prices are falling, the commercials will be looking, they'll be looking to do the exact opposite. They'll be looking to buy. When the prices are rising, they'll be looking to sell. Now, I know this logic doesn't quite make sense, but think about it this way. If you're a farmer and you're yet to harvest your crop, but you're seeing the prices for the crop that you're farming, the prices are rising. And you're seeing that if I had this crop, if I was to harvest right now and sell it off at the current market price, I would make really good amounts of money. So what you'd want to do is you'd want to go and lock in a contract for selling that allows you to sell at the current price. Later on, once you've harvested, maybe 2 or 3 months later, you can come back to the market, regardless of what price is there, you will have booked a particular price to sell. So the further up the prices go, the better the value for you if you had not yet booked a particular price. So the higher the prices go, the better for you. So you'll be looking to book prices for selling. So you'll be looking to book a contract for selling, because the higher the price it means, the more you're going to get for your crop. So that's the reason why for the commercial traders, you find that when the prices are going up, they're actually selling. And when the prices are going down, they're doing the exact opposite, they're buying. So what we are looking at in this court report is when we reach these oversold and overbought conditions. So as the prices are falling, the commercials are selling, right? It's going down, it's going, when the prices are falling, these commercials would be buying, right? So they'll be buying, up and until it gets to this low point right there. So as you can see here, the commercials were saying that this area is what they would term overbought. I know the terminologies in this is a bit confusing, but what the commercials would be doing is that they would be buying when the prices are falling. So they'll get to a point where it's overbought, and that's the point where the market would now start to turn and it would start to rise. Then as the prices are rising, what would be happening is that these guys are selling. So these are the net contracts. The net contracts are going down, right? Because they're selling as the prices rise. Then when they reach a place where it is oversold, they've sold quite a lot, that is the point where you see the market turning. Now here, when we're looking at the contracts, this is the net, right? If it's in the positive, it means that there's more buying than selling. If it's going down here, it means there's more selling than buying. So there is a bit of a confusion in the interpretation of this report, but these lines here means that this is net buying and this is net selling. So as the index goes down, that would be considered net selling. Here is also another example using the COT index. So when these commercials, at all the way down here, they've been selling all the way. As the prices were rising, they were selling. So the COT index goes below 10, and that they say is what we're considering to be oversold. So they've been selling too much. And when it now turns, that's the time that they start to see, the other group would start to see value for their trades. So these terminologies here are being represented according to the large speculators. The large speculators are the opposite of the commercial traders. And that's the reason why there is a confusion between what I'm saying and what is being written here. This overbought here is to do with the large speculators. When you're saying overbought, oversold, but how we're supposed to be looking at it is in terms of the commercial traders. So here in oversold, this is these large speculators. If you look at the green, it's going down together with the market. Then as the prices are rising, it's going up with the market. So fortunately, in the person who was recording this oversold, overbought, was using it according to the large speculators, but they were circling the section for the commercial traders. All right, so at this point down here, when the large speculators have been buying too much, that's the point where the market is going to turn and we're going to start to see the prices falling. Then at this point here, when the large speculators, notice now I've switched, I'm not talking about the commercials because these terminologies here are representing the large speculators. When the large speculators have been selling, it reaches a point where it is oversold, and what happens? The prices again turn. So a contrarian trader would be looking for these overbought and oversold conditions in the commitment of traders report as a good area for a contrarian trade. So that is to do with the institutional sentiment index. Now, when we go to the retail sentiment index, this shows the positioning of traders in the spot and CFD markets. So most of the individual traders are trading in the SPOT, that's on the spot settlement, similar to what we're doing with the MT5 platforms. So if you're trading right now on the MT4, MT5 platforms, or if you're using a broker, then you are engaging in spot FX trading, and that means that the transactions are settled on the spot. And we also have CFDs. CFDs is for non-forex assets. So that could be like the commodities, could be the stock indices, or even the stocks that are made available by scope markets. They're called contracts for difference. And they are a version of a spot contract because they're settled on the spot. Data is sourced from major retail brokers and popular social trading platforms. Social trading platforms such as Forex Factory, my FX book, eToro. Because people have linked a lot of their accounts, it means that that platform is able to populate that data coming in from traders' accounts, and they're able to tell how many traders have gone long a certain asset, how many traders have gone short. It's mostly used for short-term to medium-term trading, and retail traders' positions tend to be on the wrong side of price movement, right? And there's a way to tell this. So one of the most popular sentiment indices is the Speculative Sentiment Index. It is created by this company called FXCM, which is also a brokerage, one of the major brokerages. And it used to be provided for, this SSI index used to be provided for on the Daily FX website, because FXCM used to own the Daily FX website. But then when they were going bankrupt, a lot of issues happened in around 2015. They went bankrupt, they got delisted from the US stock exchanges. They were also delisted, or their license was cancelled as a brokerage in the US, but they're still there in UK, South Africa, and other parts. So it used to be there. Right now, it's quite difficult to get this SSI index unless you follow them on Twitter. And what it does is that it shows the positioning of these retail traders under that brokerage, because at some point it was the largest brokerage in the world, the largest retail brokerage in the world. You could get data from thousands of client positions. So it could be even from a pool of more than 10,000 clients, and you'll be able to see this positioning. So so on this picture, you can see what you can see here is maybe the graph, and then what you're seeing as this green and red is showing the net positions for long and for short. So for example, this red one shows the retail open short positions for this instrument. This is Euro USD, and the green one shows the net long positions. Now, if you look at what's happening here, we turn from net long positions, as you can see with this graph on the chart, and we turned to net short. So when most of the traders turn to net short, as you can see here, even it's represented down here, this red line crossed the green one going up. So it means the net positions were for short selling, right? So the number of selling positions rose as the number of long positions fell. So a lot of the retail traders were selling, as you can see this whole region here, net selling. Yet what's happening with the candles, you're seeing the prices rising. So the market is going inverse of what the retail traders are doing. And this retail trader sentiment index can also be used to confirm trends. You can also be able to use it to confirm the current trend that is there in the market. So that's one version of it. You can also get it in table format like this, where you're seeing different instruments here, like Euro USD, Pound USD. Then it's showing you the positioning, shorts versus longs. So here in Euro USD, you can see 63% of the traders are short, 36% are long. So there are more traders who are short. These are the volumes for both going short and for going long. So going long, there are 3,896 lots. And for going short, there is 2,234 lots. This is the change maybe since the previous day. And then these are the total positions. So the number of transactions in full. So we have 16,000 transactions for going short, and we have 10,000 contracts for going long. Then we have the average selling price. So for these 63% who are going short, what was the average price that they were short selling at? And the ones who are going, the 36% of the traders who are going long, what was the average price that they were going long at? And this can be able to give you an idea as to where the market is relative to the average price that people were trading. And in most cases, you will find that if there are more traders selling, then it means the actual price is going up in the opposite direction. If there are more traders who are buying, like in this Australian dollar versus New Zealand dollar, 75% were going long and only 24% were going short. So if you want to go to the charts to see where the prices are relative to what's going on, you'd find that the trend is actually on a downtrend. It's going against this larger group of 75 who are buying. So that's another example. Then this is an example of that Swiss, not the Swiss FX sentiment, the speculative sentiment index, the SSI for FXCM. So this is how it looks like on their chart. And you can see the trend. The trend is ranging a little bit, but if you look at the general direction, it's an uptrend. However, if you look at the net positioning, it changed here from net long to net short. So this entire period here, from these dates here, most of the traders were net short, yet the prices were going against them. Right, so it can be shown based off of this and also based off of this. Depends on how you want it, whether you want it as a histogram or whether you want it as a line. And if you look at this, it kind of looks like the MACD for some of the indicators that we have. And the market is going aggressively against these traders who are selling. So most of them are selling, but the prices are rising against, or the prices are rising against them. So to come to an end, now, sorry, I know we have extended beyond the time that was given to us. So as I end, there are a few considerations for us to think about, or a few things for us to consider if we want to do contrarian trading. So the first thing is, when constructing a contrarian strategy, you need to identify the main assumptions that people have about the market when they're making naive decisions, and then take an opposite position. So you want to analyze what are the main assumptions that people have when they're making naive decisions, and then you take an opposite position on that. Single out the weakest group in the market, and then seek to understand the collective influence behind the decision-making process. So in this case, the weakest group, out of the large speculators, commercials, small speculators, market makers, money managers, all of that entire group, the weakest link tends to be the retail traders, because they're the ones who are making decisions individually. So it means there is no collective group where you're debating and then being able to see different opinions and different points of view before you make a decision. It's just basically you. So you're more prone to emotional trading than when you're trading under a group or under a corporate entity, where there are rules and procedures. There's even a back office, a risk management, a team that ensures that none of the traders are taking greater risks than have been provided. So in that case, then the weakest group is basically the retail traders. And those are the ones that we should seek to understand, because we are retail traders ourselves. So we should seek to understand. And there is that saying, in order for you to master the market, you must first of all master your mind, right? So you must first of all understand your own decision-making process. What makes you act irrational? Because that is exactly what is going to cause you to lose, and that's exactly what the hard are doing. They're doing exactly what you do. When you're reacting to emotions, a large group of people are also reacting to emotions. Remember that sentiment indicators are not used to identify turning points, precise turning points. So in this case, they're not a confirmation of the reversal. They are an early detection system. So when we're looking at the sentiment index, the institutional sentiment index, we use that as an early detection system. When it comes to the retail sentiment index, you can use it both ways. You can use it as a way to confirm the prevailing trend in the market. Just look to see what people are doing, and then go to see whether the trend is opposite of what most of the retail traders are doing. But to use it as an early detection system means you use it in the sense that when there's overbought and oversold conditions. For example, with the contracts that are being taken in the court report, when we see that the commercial traders are aggressively selling at this particular time and price, then that should mean that the prices are likely now to change, because the trend is going up, but this group are actively selling. It means that at some point the prices are going to turn. Test out your models using past data to gauge the consistency of the signals. So again, you must have a reason as to why the market, as to why your decision-making process is going to work. So you've got to test it out in the past, try and see what the discrepancies are before you start implementing that strategy in the future. But also remember, markets can remain irrational longer than you can remain solvent. This is a saying or a quote by John Maynard Keynes. Is it Keynes or Keynes? And it says that markets can remain irrational longer than you can remain solvent. So as much as you're the only rational person in the market, you still need to wait for the rest of the group to change, or at least for the main participants to start viewing the market from the perspective that you're viewing it. And that means if you're early, you should practice sound money management so that you can be able to withstand the drawdowns before the rest of the market catches on to the new trend. All right, so that marks the end of my presentation. If there are any questions, maybe I can address them quickly before we end the session for today. All right, so we are seeing some questions here. Where do we get institutional sentiment index? You can get it from the CFTC website, but the best website to go to is barchart.com. So if you can go to barchart.com, you can be able to see the charts So you go to barchart.com, and be able to load a court report chart. So you can go to the currencies, and then there's a section there where you can look for the commitment of traders. And you can select the kind of a chart that you want to view the court report or those court charts. There's someone else who's saying, what is the opposite of spot trading? And is it commercial traders who participate in the opposite of spot? Spot market trading just means that you're settling the transaction on the spot. Usually, futures contracts are settled in the future, ergo the name futures. So you're locking a price today, but you're going to act on the contract, or you're going to transact later on at a predetermined point in time. So that could be like in July, because we've already surpassed the March settlement. So you're going to settle. If you're taking on a futures contract right now, it's either for the June or July settlement, and also maybe for September settlement. So you're taking on a position right now, you're locking a price today, but you're going to settle sometime in the future. But a spot trade, you're buying it right now. So it's being transacted on the spot. Commercial traders engage in the futures contracts, and that's why they are in the court report. Court report gives us the commercial traders, the positioning of the commercial traders, and also of the institutional traders. These are the ones who are taking the opposite side of the commercial traders. So commercial traders and institutional, or the large speculators, who are the hedge funds and the investment banks, they're on opposing ends. They're the ones on the opposite side. When it comes to the spot market, the ones on the opposite side of the retail traders are the market makers, the brokers who are market makers. So those are the guys who are on the opposite side. So when they say that the house never loses, what they're referring to are the market makers. And this is because the market makers just do the exact opposite of what the retail traders who are trading within the environment are doing. Currently in Kenya, we do not have any licensed market maker. So all the brokerages, the forex brokers who are licensed in Kenya, including Scope Markets, are non-dealing desks. So they are not market makers. They do not take the opposite position of our trades. All right, guys, due to time, I'm not able to answer all the questions. However, if you join us in the Scope Markets Telegram group, we have a Telegram group. I believe a link has been posted there. Or maybe Sylvia can post a link to the Telegram group for Scope Markets. We can continue the discussion there. If you want to get in touch with us, you can contact us through those contacts that Sylvia has provided, stlfx@gmail.com, and also that number. And yes, so you can share the Telegram group there, the link, and we can continue the conversation. So thanks again, guys, for joining in. I know we've overextended. It's a Friday, but that just shows commitment from your end, that you're committed to learn. Thank you so much for your time. Enjoy your weekend, and hope to see you again for one of our webinars next week on Friday. Every Friday is a Forex Friday with STLFX. Thank you. Have a blessed weekend.